Coming up on today's show, Apple's extremely concerning earnings and what I think of them, what to expect in the year of the snake, sentiment, and why this chart could spell the end of the financial markets. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks gained steam on Thursday as investors digested mega cap earnings and a slew of mixed economic data. And guys, it was green across the board. It's actually far more constructive to actually talk about the red areas of the market. Now, we saw your Netflix and CRM were both down today, giving some back after the stellar week that they're both having. Microsoft led the mega caps lower, down 6.18% on the back of its earnings. Apple was down 0.45%. Amazon was down 0.99%. Guys, funnily enough, Nvidia and most of semiconductors and hardware actually gained here today. Same with software. And then we also saw Tesla up 2.89%. There wasn't really much red in this market at all. Healthcare gained, commercial services gained, financials gained. It was a rally across the board. Every single sector gained today, with the standout sector being utilities up 2.12%. But when you look at it, utilities, real estate, industrials, healthcare, discretionary, materials, staples, financials, right? These pretty much all gained in excess of 1%. I know XLF up 0.97%, just shy of 1%, but they all gained more than 1% today. Guys, this isn't just a rally. This is a broad-based rally. The S&P 500 only gained 0.55%, and that's because we saw the XLK only up 0.17%, and the XLC, right, and this includes Nvidia, Apple, Microsoft, Meta, Google, and some of the communication names, they took it on the chin today. And again, we are starting to see that value rotation, that broad market rotation. And it's exemplified by the fact that small cap growth and mid cap growth are the outperformers here today. So the market definitely still reaching for growth, especially in the economic environment we have right now. But they're looking at more of the mid cap segment of the market as well as the small cap segment of the market. And we did see that the market, when it comes to large caps, really putting an emphasis here on the large cap core component of the market compared to the value and the growth segment. But, looking at small cap value, looking at mid cap value, mid cap blend, small cap blend, they were all up in excess of 1%, except mid-cap value, which is up 0.76%. And no matter where you were positioned in the market, as long as you were indexed, you did very, very well today. Even large-cap growth up 0.48%. You take those gains as they come any single day of the week. The only red you saw today really had to do with earnings, and it wasn't just the US market. It was globally. We saw a rally, except in this part right here, Southeast Asia. This is sort of like the semiconductor construction belt of the world. Stuff like Taiwan, Malaysia, Taipei, they are heavy into the semiconductor trade, especially the manufacturing pace, and they were down today. But we saw green in Europe, green in most of Asia, including India. North America was very green. So too was South America. South Africa was green. Parts of the Middle East were green. It was a green day through and through, including Australia, my home country. Now, guys, the markets rallied on two things today. It was the earnings picture as well as the economic data. And we got the latest Q4 GDP estimates, and the US economy grew at an annualized rate of 2.3% in the fourth quarter, falling short of the 2.6% estimate. Now, for the full year, guys, we officially grew 2.8%. There will be Q4 revisions coming in the next couple of months, so we'll see if we actually get up revisions. I think we are going to see this number improve ever so slightly, maybe 2.4, maybe 2.5%. But the full year GDP came in at 2.8%, growth looking largely robust. This was below 2023's 2.9% and above 2022's 2.5%. So economic growth still looking solid, but the overall data for this quarter coming in a little bit weaker than expected. Now, we also did get pending home sales, guys, and this was an absolute dumpster fire. I don't know how real estate was not down like 3% today, but pending home sales, right, it was down 5.5% on the month. The consensus was for no growth, so huge disparity there. And in year over year was negative 5%. The forecast was for 4% growth. So pending home sales was a bit of a dumpster fire, but all of this weaker data was offset by very strong initial claims, which came in at 207 versus the consensus 220 and the forecast 228. And we also saw very positive revisions here to these numbers, 225 to 223,000. That's what you love to see. So very mixed economic data, solid labor market data, and the market did its thing. We did see quite a lot of volatility in today's trade, but green nonetheless. And now the other parts of the market that did move was earnings right now. UPS was down 15% today after announcing it'll cut back on Amazon deliveries. The stock tumbled as much as 15%, and we saw a material hit to guidance. The management team now guided for $89 billion in revenue, where the market expected 95 going into this print. So that is a huge hit, and that's why we're seeing the market reaction like this. I think poor management to come out and release these on the earnings. They really should have given the market notice in advance of this. So to see this, I wouldn't be surprised if we actually saw some form of a class action hit up UPS's doorway. Now, MasterCard was up 3%. They beat on both the top line, bottom line, and it was just business as usual. There wasn't really much to say with regards to their earnings. Business as usual. I have Visa in my portfolio. Very green today. You love to see that type of stuff. These are the stocks you really want to work long term. Now, Oracle was up 5%. It debuted its latest AI agents aimed at manufacturers during its Cloud World event in Austin. The agents are designed to help supply chain workers across a host of jobs ranging from procurement to sustainability. AI agents are specialized AI bots that can take actions on the user's behalf, either autonomously or with oversight across multiple apps. Now, another market mover today was actually Tesla. Very volatile. At one point, it was negative. At one point, it was up nearly 6% on the day. And this was on the back of a double miss and just absolutely atrocious earnings, guys. I don't know how the stock is not down 50%. I don't know how the stock is not at $350 per share, but it was really bad earnings. They missed on top line, missed on bottom line, a whole range of economic indicators. They just missed everywhere. I don't know. This stock is completely divorced from its fundamentals. It shouldn't be at 405 based on these earnings, but there you go, up 4%, really helping the mega caps move. And then, guys, looking at Apple, one of the biggest market movers here today. Now, they were down a 1.15% here in the after hours. They had quite a little bit of a move up upon their earnings, and now they're down about 1% here after hours. So the market very indecisive about what to think about Apple's earnings, but revenue came in above expectations. So too did earnings. So they beat on the top line and bottom line. Revenue grew 4% from a year ago. Some positives though, the installed base of active devices reached a new all-time high. But there was some very, very concerning things in between the top line and the bottom line. The iPhone and wearables all missing, shrinking year over year. And what's up with this free cash flow number? Free cash flow came in at 26 billion. The consensus was for 36. That's a 25% miss versus the consensus estimates. And free cash flow came in at negative 28% year over year with not much capex spend. Yeah, little to no capex weighing in. Very, very concerning. But I think the market is looking at the headline numbers. And that's why you see the reaction. But at like 25% miss in free cash flow, the stock should be down greater than like 4 or 5%. But the market somewhat liking what they're seeing right now. All in all, very solid quarter here from Apple, but we just want to get some more color on what this free cash flow means, unless these numbers are completely incorrect. And Microsoft, something that's true to the fundamentals at the moment, down 5.87%. Now, it beat on top line, beat on bottom line. Azure growth came in slightly weaker than expected, and that's why we saw the market reaction we did today. And for everything we saw in the market, guys, market breadth was very, very solid. 4,400 advances, 1,700 decliners, most of these being in the S&P 500, and that's why we saw indices up in a very big way today. And then looking at market momentum, shorter term, longer term, and medium term averages look very, very solid. And this is what we normally see in bull markets. Pullbacks are very short-lived. You buy the dip, hold, onward and upward, you make money. It's why we love bull markets. But let's hop on the charts. Now, today's trade was very bullish. We saw the S&P 500 and the Nasdaq 100 up 0.5%, exemplified here by the Qs. But the RSP outperformed. So too did the IWM, both up 1%. Mid caps and small caps were up 1% as well. So again, the broader market really seeing outperformance, relatively speaking. And again, that has been the theme of January in 2025 so far. But on the back of the weaker economic data we got today, yields actually fell and the dollar actually gained. Very interesting dynamic, and we saw bonds gain as a result. Metals were very, very positive, and I think, the market's still trying to gauge the tariff situation as well as the weaker economic data, and that's why we did see some of the price action we did here in yields and metals. And then crude and nat gas were slightly down. Nat gas was down 3%, but it's a very volatile asset nonetheless. But for all intensive purposes, guys, we continue to do what I expected we would do on the back of the massive drop or the deep seek drop, this gap down we saw. And that was after the gap down, the markets came in, bought the dip. We remained above positive gamma. We broke above Tuesday's high, closed above Tuesday's high. And that's actually a really, really good thing. It probably means we go ahead and touch the 6100 area. A lot of market resilience here, especially being helped by the mega cap earnings, Tesla, Meta, etc. So very positive momentum here for the S&P 500. Towards the end of the week, what I would love to see is a close at or maybe even slightly above the 6100 area. So if the market can just have one more day of a very solid rally, close the gap, maybe even close above Friday, last week, Friday's close, that would be very, very constructive, all things considered. And that would probably mean we go ahead and take out those highs, aim for new all-time highs. There was so much uncertainty during this deep sea drop, and look at where we are right now. We've nearly recovered all of it. In fact, we're at the lows here of last week, Friday. We touched the lows in yesterday's trade. Now, we did see quite a bit of volatility. If we look at the one-day price action, right, we saw the market rally. I'm not really sure what happened here, if there was a news event, did Trump go tweeting, but then we saw, the market pair almost all of the gains at the getting to the zero mark, and then we paired all of those losses almost. So we were positive on the day, as you can see, but yeah, very violent price action here, very interesting. And I don't know what news event happened. Could we see any news event? S&P 500. Yeah, there was no massive market moving event. I mean, Apple only reports after the bell. But yeah, very volatile price action in the S&P 500. And you could see it with the Nasdaq 100, we were up 0.45%. Very similar situation, although it hasn't made the same recovery that the S&P 500 has made. However, it stayed above the positive gamma, which is above this gamma flip line. And we've continued to move onward and upward. Very good, very solid price action. And guys, the game we play. Above the positive gamma, we're aiming for the core wall. And for the Nasdaq 100, we're looking at the 21,915 area to close the week. And for the S&P 500, we're looking for the 6100 area, although we're pretty much at the top end of the range. But if we can squeeze the last bit of gains and close at the highs here for the week, that would be very, very positive. Now, looking at the RTY up point, now the IWM was up 1% here today, now down 0.25% in the after hours. So a lot of negative price action being priced in the after hours. What we saw with the IWM today is that we actually went ahead and touched this core resistance. It didn't move up. So this core resistance is acting as a very strong resistance zone. Just can't get above it. But the second we do get above it, we're going to see an absolute move to the upside. But it's going to be really up to the bulls to go ahead, take this area, consolidate, and then make the next move higher. All things considered, this is strong resistance. And as long as we're below this line, we're probably going to continue to range trade in this area. And I think it's constructive to buy dips at the gamma flip, especially considering how the market is acting. I mean, look at the RSP up 1% today. Mid caps, small caps looking very constructive. I mean, the RSP looks really, really good. I mean, you could say that right here, we were forming a base, like we said, and we've broken above the base, a close above. And now we want to use this zone here as resistance and then make the next move higher. Let's actually go ahead and draw a trend line right here. Okay, right there. So if we can pull back to this level right here, this zone, okay, use that as a support zone, then make the next move high. We can then target the 186 area, maybe the 184 area first, and then the 186 area. But ultimately, all-time highs, that is our aim. So very constructive price action across the board. Yield did come down, slightly stronger dollar, but that did help the overall market momentum. If we continue to see yields move in the way we expect it to, this should be very supportive for equities. We have seen that yields have come off their highs right here. Plenty of uncertainty here. The market breathing a sigh of relief. And we're at a very, very key level. It's this level right here, the 4.5% level. If we go ahead and actually break this level, use it as resistance, we can then look to the 4.4, 4.3. And you can see it's the same place we used it as resistance right here in November and made the move down to the 1.52%. So the market's sort of trying to find support right here. But if we do break below, that's going to be very, very constructive, particularly for small caps and mid caps. They are really tied to how rates work. All in all, guys, as long as rates keep coming down, we're at a key level. If we break below this key level, that's going to be very constructive for the market as a whole. The dollar continues to remain very, very strong, but very similar to what we're seeing in yields right now. It has come down and we're at this very key and critical level. The next move will come on the break or retest
of this level. And if we continue to consolidate here, I think the market would be happy with that. If we break it, that would be the best case scenario. I do think we're probably going to see something like 105 in the dollar, but only in the second half of 2025. I think we're going to see a material stronger dollar over the next couple of weeks. And I think we're just going to gyrate between these levels as yields come down. And that can actually happen. Look at the 2-year, 10-year, 30-year yield. They all fell today when the dollar gained. We can actually have the type of price action where like the dollar stays flat, yields come down. That would probably be very, very constructive for small caps because the domestic economy isn't really tied to the movement in the dollar. In fact, they do actually favor a stronger dollar. If you have weaker rates, stronger dollar, that's very constructive for the domestic economy. And it's mid-caps, S&P 600, the IWM and the RSP should do very well regardless. But for all things considered, guys, everything's looking good. It's risk on. Bitcoin was up 1.36%. Yeah, metals continue to be volatile. And this is the bit consigning gold up 1.2%. But we're still at the 2,700 mark. Actually, no, we just hit an all-time high in gold. That's very, very interesting. That could be concerning, but generally speaking, when you have the dollar rising and gold rising, that's indicative of us just being in a bull market and, money pouring into just risk assets as a whole. Safe havens as well. And that is why, gold at a new all-time high. That is absolutely crazy. Who would have thought that? Actually notching 2,800 today. Very interesting. The highest close ever for gold. Gold looks really, really strong. I mean, we're just making higher highs, higher lows. We did have quite a bit of volatility here, but onward and upward. Guys, I think equity markets look really, really good. Even with the DeepSeek price action we saw, the S&P 500 recovered really well. The Nasdaq 100 recovered really, really well. And the game plan for tomorrow, guys, we're trying to aim for the core resistance in the Nasdaq 100, the S&P 500 as well, pretty much at the top end of the range, and the IWM, unless we actually break or see a move up in the core resistance, we want to be buyers of dips here at the gamma flip zone. For all in all, guys, buy any dips we do get. Markets look good, equities look good, the macro looks good. You don't really want to fight the trend. And diving into sentiment, this is the AAI sentiment survey. Just a survey asking, where do these individual investors feel the stock market will be in the next 6 months? And guys, while we did see a steady downtick from sentiment here in the last couple of months to as low as the 24.5% level, we then last week saw a huge uptick in sentiment on the back of the macro and Trump's comments. And after the DeepSeek situation this week, we saw another downtick in sentiment again, only to the 41% level. And if you look at the historical average, which generally is about 33% for each of these sentiment votes, we are still above the bullish sentiment here, in line with bearish sentiment and well below the mark with regards to neutral sentiment. In other words, bullish sentiment is still elevated regardless of what we're seeing in the mega caps, and that's simply because we've seen stark outperformance in the broader market, mid caps, small caps, the equal weight, and this is what's keeping sentiment elevated and likely will drive market returns for the rest of 2025. Now, what should we expect in the year 2025 or the year of the snake? Well, something really fun here, nothing significant to go by, guys. It's a very thin pool of data. Normally you need about 30 data points for anything to be statistically significant. We have 6 or 7 here, but you can see that the average S&P 500 return in the year of the snake is 0.8%, median 2.5%. So this could be a little bit of a red flag for the market, but when you dive into it individually, you actually see some outsized upside returns as well as outsized downside returns. So what can we expect from a year like this? General volatility is what I would expect in the year of the snake in year 2025. But don't take your eyes off the prize, guys. We are still very early in this current bull market, and it's made it past its second birthday. Officially, this bull market started in October 2022. This is where and if you look at other major bull markets and where they ended up, yes, we saw a lot of volatility, but all in all, what you can expect is price action to go higher from here. But generally, what we do see in the third year of a bull market is generally sideways price action, right? We sort of digest all of the strong macro earnings that we normally get in bull markets. And then in the third, fourth, and fifth year, we continue to make the move onward and upward. Generally speaking, the average bull market lasts to about the fifth year. So if this is anything to go by, we still have another solid 2 to 3 years of gains in this bull market. However, a big criticism with the current bull market that we do have is valuations. And by most measures, stocks are historically pricey. And with yields on US Treasuries climbing towards 5%, I do sympathize with investors' unease. However, I wouldn't be too concerned. Investors are always willing to pay more
for higher earnings growth. And today's S&P 500 composition is growing earnings significantly. And it's not just the earnings growth that's a concern. The companies at the top, Google, Meta, Apple, Nvidia, Microsoft, Broadcom, TSM, JP Morgan, Berkshire Hathaway. These are extremely high quality and highly profitable companies with deep rooted moats, not just in the US, internationally as well. So look guys, long-term earnings are growing. And yes, this does mean you have to pay up for stocks, but you're also paying for extremely high quality stocks. And I think it's worth paying up for those because in the long term, quality is the best performing factor above value, above blend, above all the other factors. So where do we actually stand with earnings so far here in Q4? Right now, we're looking at 10.1% earnings growth, slightly above the estimates at the start of this earnings season, 4.1% in revenue growth. However, if you exclude the energy sector, which in my opinion is a little bit of a dumpster fire, no, a huge dumpster fire, a forest fire, I should say. If you exclude energy, you're looking at 13, sort of like that mid-low teens growth, 4.9% revenue growth, respectively, with margins coming in line, guys. And 94 companies have reported in the S&P 500, so about 1/5. We are looking at a pretty good beat rate, 81% of companies beating analysts' expectations. All in all, I think earnings are great, and it's going to be supportive of the higher valuations. And what also supports the high valuations is simply the macro, guys. Look at the economic surprise index. Yes, we've seen huge upside surprises in the last 6 or so months. Yes, we did come down a little bit here. However, we continue to see upward economic surprises. And we're slowly moving up. For the record, the zero line is about here. So we've stayed above the zero line even as we pulled back here into January, and we've seen a very, very strong economic data ever since. And while the economy continues to roar, so too does the consumer. Household balance sheets remain remarkably robust despite concerns about the depletion of excess savings. That was a big narrative last year. The ratio of total assets to liabilities is at an all-time high. The ratio of liquid assets to liabilities is about 10 percentage points higher than it was pre-pandemic. This supports my optimism on the health of the US consumer and will continue to drive US equity returns, the economy, the macro as a whole. And something else, guys, labor productivity rate has picked up in the past 2 years and is running above the pre-pandemic pace. And guys, strong labor productivity growth can be one of the reasons why we solve the deficit. In 2025, we're looking at a potential $1.94 trillion in deficit, a 28% deficit relative to the spending we are bringing in. And if there's one thing that can cure this, it certainly is labor productivity, among other things. But higher labor productivity simply means higher growth, and you really want to grow yourself out of a deficit when compared to austerity. Now, guys, let's talk about earnings for the rest of the week. The big boys, they're officially done. What a turbulent week. One of the most volatile weeks of earnings I've ever seen, guys. Now, tomorrow, Friday, we have ExxonMobil, Chevron, AbbVie, Colgate-Palmolive, so some very, very big names, Booz Allen Hamilton, as well as Phillips, and then Brookfield Corporation, they're reporting as well. So the huge week of earnings actually continues tomorrow, but we do actually see a material slowdown from here on out. Nonetheless, what a crazy week it's been. These are the weeks we live for. We made some money, we lost some money, such goes the market. And then looking at earnings tomorrow, guys, we have the big one, the PCE, inflation, and we also get the personal income outlays, personal income month over month, and personal spending. Now, for personal income and personal spending, we're looking for a 0.44%. That's what the consensus is saying. And then for core PCE month over month to come in at 0.2. We hit these figures, particularly this inflation measure right here, and the personal income outlays come in line. I think stocks are going to rip on that result. Guys, we want cooler inflation right now, particularly with where everything is. This administration, tariffs, rate cuts, the work. We need inflation to come in cooler than it is. I think we are going to print this number right here, but anything cooler would be welcomed by the market. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.